Our speaker today is an accomplished 17-year veteran trader and portfolio manager, and someone who has earned a credible reputation by sharing his investment insights. You may know him as Goldfinger or by his Twitter handle, CEO Technician. Let's welcome Robert Sinn.
About markets, the macro picture, and how to position ourselves for 2021. As always, this is not investment advice. This is my opinion. When we talk, or my opinions, and when we talk about specific companies later on, if you ask me about some junior miners or individual stocks, you can probably assume that I'm biased in some way, shape, or form. Either I own the stock or I provide marketing services for a company, and I'll try to let you know if that comes up. But basically, the format. And by the way, I'm wearing a Dolphins cap, as you can see, because I went to the Dolphins game on Sunday and they won. So I'm a little excited about that. I'm going to start with sharing my screen and talking about, I'm going to share some quotes from some people who are a lot wiser and smarter than me, and just sort of lay the groundwork for how I like to think right now and for how I like to think about markets. And sort of approach this webinar as if we're aliens that have just been dropped onto Earth from outer space. So we don't have an existing portfolio. We're just assessing the landscape as brand new investors, like baby investors that are just born into the world. And maybe, we've got a chunk of money that we want to invest and get a good, return on over the next 12 to 24 months. So that's how I'm going to approach this conversation. And obviously, that may not be the case for most of us, but still, I think it's a good way to think right now, especially with the market is just closed for the day. And we have all this noise, this constant noise, news cycle going on in the background, right? But really, a lot of that news is probably not going to make us money. It's probably not going to make us smarter. It's probably not going to inform our investment choices very well. So let's try to, meditate for, an hour or, a little less, and take in some, wisdom and try to get a little bit smarter. I highly recommend this book by Howard Marks, Mastering the Market Cycle. I think all of his writing is very good and highly recommended, but this book in particular, this is like my Bible. When I feel ungrounded or shaken by the market and I need to get back on the ground and get back to the principles, the fundamentals, this is what does it. So I highly recommend you all read this and maybe go back to it time and time again. So anyway, that's enough of my face. Let's share my screen here. So this is just a Google Doc that I put together with what I think are some really important quotes, some words of wisdom that I want to sort of start our conversation here this afternoon. And by the way, I'm going to do a question and answer session towards the end. It's going to probably be a little bit longer than normal. So if you have questions about the macro picture, or a question that I can actually answer, okay, don't ask me who's going to win the election or something crazy like that, right? Something about maybe a stock that that I follow, or macro market structure, or advice on your psychology as an investor, put that question in the chat box, and I'll do my best to answer it later on. So this Warren Buffett quote: "The stock market is a no-call strike game. You don't have to swing at everything. You can wait for your pitch. The problem when you're a money manager is that your fans keep yelling, 'Swing, you bum.' And while probably most of us aren't money managers, we're probably just managing our own money. We talk to ourselves, right? And we're on these fire hoses of information and opinion on co.ca or Twitter or wherever, it may be. And that affects our internal dialogue, right? And there's this constant tendency to want to do something because the market's always moving. There's always a bull market somewhere. There's always a bear market somewhere. There's always something going up, something going down. And there's this, just as human beings, we don't want to miss out, right? It's called FOMO, the fear of missing out. But in reality, in financial markets, the two most common emotions that can make us make bad choices, bad decisions, and cost us money are fear and greed. And it never changes. It always goes back to fear and greed. And FOMO is greed. It's the emotion of greed. I don't want to miss out. My neighbor just bought a new Porsche. I want one too. I need to find the next stock that's going to go through the roof so I can get that Porsche, right? And that's usually what ends up having us buy stocks or buy into really bad investments and make poor investment choices, right? And so I start with this one because there's so much happening in the world today. And the market has had it was a pretty big rally in the stock market, in the S&P and the NASDAQ, right? A lot of stocks were up pretty big today. But, it doesn't mean that we have to buy right now, this afternoon. In fact, I feel like, generally speaking, having some cash right now is actually a very prudent thing, because I feel like there will be better opportunities that, await us over the coming weeks, maybe, in the next 2 months, right? The final 2 months of 2020. I feel like there's going to be some really nice opportunities. We'll talk about that more later. And then this is me quoting myself. I don't really like to quote myself often, and I usually think people who quote themselves are kind of lame, but I just thought this one was really important and very apropos, because it's something I said recently. It's something I've been feeling. If I always just simply bought stocks when I was fearful and it felt psychologically impossible to buy, and I know we've all been there, where there's always been those days where it's like, God, just looks so awful. I can't buy here. It's going to keep falling, right? And it's usually those times where it's the best opportunity. In recent memory, March 23rd, you can pull up a chart of the S&P or the NASDAQ or anything. March 23rd, the morning of March 23rd, it felt like the world was coming to an end. It felt like, we're all going to die from COVID. The economy's never going to, restart. Government has no plan for anything. And I could keep going, yada, 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 right? It was an awful time. That was the low. That was the low. If we leveraged up every dollar we had and bought S&Ps or stocks on margin and held for a few months, you wouldn't have to have a job anymore, probably. That's how good of a buying opportunity it was, right? But it was psychologically impossible to buy, right? It was very, very difficult. But prices were very low and expectations were very low and fear was very high. And that led to a tremendous opportunity. And then to end this quote, and sold when it seemed like prices could only keep going up, I would be way, way ahead of the game. And so this quote is helping to talk about what Howard Marks talks about very often in his writing, Mastering the Market Cycle. When markets, prices, stock prices, market prices seem like they can only keep going up, that the recent past will be extrapolated into the future forever, that's usually the top, or that's a hell of a good time to sell. And just the opposite, when there's maximum pessimism, and even people who were bulls previously are now bearish and don't want to own stocks, and prices are very low, and everything looks awful and feels awful, and the news is all full of bad headlines, that's the best time to buy. And so that can sort of inform us going forward as to the most effective psychology to have as market participants. Another Howard Marks quote, we reach, and this is another one that's, I think, is very important, because our foresight is always inadequate. because none of us know the future, right? And we're using our optimistic or pessimistic biases to inform our analysis and our choices, but we never know the future. The future is always uncertain. That's why it's so funny when you turn on financial news and they're saying this is an uncertain market environment. Well, when is it not uncertain, right? And so it's just, acknowledging that everything in markets is probabilities and it's uncertainties, and it's not certain. It's not certain. And how about the last 24 hours for teaching us about certainty and uncertainty? Really, none of us really know anything, right? We're just making this all up as we go along. It's a big game. The tendency of people to go to excess will never end. So true. And thus, since those excesses eventually have to correct, neither will the occurrence of cycles. And this is the most important thing that we can understand as investors, is that everything is cyclical. And that means that investors with the ability to understand cycles will find opportunities for profit. And this quote and this insight informs us as to where we're going in this conversation here this afternoon. And then it's not supposed to be easy. And anyone who finds it easy is stupid. Charlie Munger, legendary investor, extremely intelligent human being, just saying something that's so simple. It's a laughable comment, but it's so true. Markets aren't easy. They're not supposed to be easy. And anybody who talks like it's easy or acts like it's easy doesn't know what they're talking about, or they're just lying to themselves or lying to you, right? And then Dr. Brett Steenbarger, greatness is staying in the game. So important. Stay in the game. This is something that I talk about all the time. If we just stay in the game and minimize our losses, we're going to have losses. It's the nature of the beast. It's the nature of markets, is that we're going to have investments that don't work out. We're going to have trades that we get stomped out on, and that's okay. It's the price of playing the game. But as long as we stay in the game and keep improving, then we can set ourselves up for big wins, and they will happen. They will happen to you as long as you stay in the game and allow yourself to have them, right? Don't sell too soon. And then David Einhorn, which is this quote is so brilliant. Again, it's just two sentences. It's very simple, but when you get to the core of it, when you really feel it and understand his words, I think it's brilliant. What matters in a bubble is market psychology, not valuation. Valuation is irrelevant, and that's what makes it a bubble. Valuation is irrelevant. So it's when market participants become completely unhinged from reality and economic value that they basically generate bubbles, right? And we've seen so many bubbles through market history, and I'm not going to recite them all, but I think this is very important to understand as well, that valuation doesn't really matter that much. It can affect market psychology, but market psychology is much more powerful than valuation, especially at market extremes. So now, enough of the wisdom, but I felt like this was very important to go over here this afternoon. Now getting into my macro thesis for how I position myself for 2021. Deflation. Low economic growth, weak economic growth, sluggish economies throughout Europe, the US, Canada. A lot of the advanced economies of the world, the biggest pools of capital and economic activity, are very, very sluggish. And the central banks, namely the Fed and the ECB, are focused on creating inflation. They are not concerned about generating inflation that is too high right now. They are much more concerned about price pressures. And this chart says it all. Look at the CPI. Look at the percent change in the M2. So money is not moving. It's like in medicine, most sickness happens when the blood stops circulating well. It gets stagnant. That's when bad things happen to the human body. Same thing in the economy, right? Money needs to be moving. Banks need to be lending. New businesses need to be starting and hiring new workers and generating tax revenue and economic growth and creating optimism. When things stagnate, it's not good, right? And that's what's happening in the world today. A lot of stagnation, structural challenges, debt, massive debt overhangs, weighing like a 100-pound boulder somebody's trying to push up a steep mountain, right? And the Fed and the ECB are trying to fight this with the tools they have, but the tools they have are becoming less useful. They're less powerful. And their effects are, declining on an incremental basis. So the QE was a big deal when the Fed first did it, and during the global financial crisis, it saved the economy, it saved markets, right? And now the balance sheet of the Fed is over $7 trillion, and it will continue to grow, but the returns on the Fed's investment, quote unquote, continue to be quite poor. COVID is but one factor, a symptom of much bigger structural challenges facing economies. MMT, modern monetary theory. And so this is where we are today. I don't want to talk politics or the election, regardless of who wins, Biden or Trump. MMT is here to stay. And especially if it's a Biden win, I believe it will be fully embraced in the US in 2021. We will see record levels of money that's generated and printed, right? MMT is here to stay, and governments across the world are embracing it. The Fed will continue to support fiscal policy and accommodate markets through monetizing the debt. This was unthinkable 20 years ago. It was even unthinkable maybe 10 years ago. And now it is standard operating practice for the Fed and the ECB. They're literally monetizing government debt by buying that debt from governments on the market. And meanwhile, the governments continue to have bigger and bigger deficits and bigger debt piles. And COVID and all of its side effects is just making this much worse and much, much bigger in Canada, in the US, in the EU, in the Eurozone, right? And even in smaller economies, right? But economies we don't talk about as much because they're smaller, but they're there nonetheless, and they still face a lot of the same challenges. Two key tenets of MMT are a government cannot be forced to, default on debt in its own currency. So the Eurozone can, in theory, never default on debts in euros. They just create more euros to pay the debt. Same thing with the U.S. with the dollar. The U.S. government can always repay its debt because it can just create more dollars and the Fed will monetize it, right? And then this MMT is only limited by inflation. And inflation can only really become a problem or accelerate once, and this is very key to understand for where we're at right now. Real resources of the economy are utilized at full employment: labor, capital, natural resources. Natural resources, that's something that we're going to get to later. So we're not anywhere near the constraints of MMT in the US. I'm just using the US as an example. It's the economy I know the best, and it's also the biggest. We're not near the Fed's mandate on inflation. We're not. The Fed's not close to achieving their inflation mandate. We're also not achieving the Fed's employment mandate. So the Fed has plenty of firepower, plenty of room to support the Treasury, the government, in its MMT in 2021. And it might even start sooner than 2021, but it will definitely happen in 2021. We will see more money that is created out of thin air in the next 12 to 24 months than probably the entire world history put together. That's how serious this challenge that we're facing is. Inflation is not a threat. Stop reading stuff and thinking about hyperinflation. It's not the threat right now. It's not happening. It might happen in the future, maybe a few years from now, but it's not happening and it's not a threat right now. And that's what's going to create this cycle that we're about to skyrocket into. I already said this. You couldn't ask for stronger tailwinds for precious metals and natural resources. So when you know that the dollars, the currency, the paper that you hold either in your hand or in your bank account or wherever is going to continue to be worth less at an accelerating rate, what do you do as an individual or as an investor or as an institution that has a mandate of generating a return, a real rate of return for yourself or your investors, right? You're going to go to things that are limited in supply and will be sought after by everyone over the coming years. Natural resources and precious metals. Negative real interest rates and the prospect of more deeply negative real rates combined with record levels of new money being generated out of thin air equals rocket fuel for hard assets and stores of value such as gold, silver, and maybe even Bitcoin, as we've seen in the past couple of weeks. And I found this graphic to be just tremendous. I forget where I got it, but it was put out somewhere in the sphere in the last couple of days. So this is literally the central bank situation in the world today. They're pouring this liquidity into a leaky bucket, which is the global economy. And it's kind of like pissing against the wind or pulling on a string or whatever metaphor you have, but it's all they can do. And they're going to keep doing more of it. And we're going to get more of the MMT, which is going to be the real rocket fuel for natural resources and precious metals. And then this graphic, so this is the top 10 economies in the world in 2030. Obviously, this is a forecast. As always, the future is uncertain, and forecasts can be not entirely accurate, especially 10 years from now. But this is probably going to be pretty close to the way the world will look in 2030. The top 10 economies of the world. Well, the top two are going to be China and India. And China's economy will be more than double that of the US. That was completely unthinkable 20 years ago. But here we are today, and China is on its way to being the world superpower in every aspect, including population, armed forces, and money and economic growth. So these massive countries, China and India, which together account for 2.5 billion people or something, they are hungry for precious metals and natural resources, starving for both of those things. And they will fuel the bull market that we will ride over the next decade. Okay. So this is basically it. This is my presentation here this afternoon. And this is why I think as we get ready for whatever is coming in 2021 and whoever is the president in 2021, we want to own hard assets We want to own, and even a lot of people will say you don't want to own oil stocks with Biden presidency. I disagree. I think that oil stocks are actually very attractive here. And oil is a resource, and a lot of probably governmental policies that will be put into place will cause oil, supply to be less over time, and that will increase the price. So it's a controversial one, but I'm a contrarian. I like oil and oil stocks here, and I think we're going to get over this COVID thing at some point in 2021, but the economy won't go back to being the same. Okay, it just won't. It's forever altered. So talking about cycles. So I'm going to go to the gold chart, show a couple other charts, and then I'm going to open the floor to questions. We could talk about some junior mining stocks and whatever else you have. But generally, I want to own companies that have either found a lot of gold and are going to mine it for a big profit, or are about to make a very important new find. Because honestly, the world is in short. There's not enough mines coming online over the coming years, and not much money has been spent exploring in the last decade because of the bear market in pretty much everything. In terms of gold, silver, copper has had a very rough time since about 2011 or so, and yet all of these metals are moving back into their super cycle. So the cyclical bear market has ended, and they resume the long-term secular bull trend. And we just have to look at the gold chart to understand this. This is a long-term secular bull market. And, the market doesn't do the exact same thing over and over again. In fact, it rarely does, but it rhymes. And so we look to the past to inform us and give us a very loose roadmap for the future. And so if we look at the bull market of 2001 to 2011 in gold from a technical standpoint, we'll notice some key structural characteristics. It stayed above its 50-month moving average the entire time. And you can see when that 50-month, the blue line on this chart, just started to turn up around 2003, just like it's just starting to turn up in 2020. Well, 2003, if you were a gold investor, was a time to buy hand over fist, and was a time to get into junior miners hand over fist. And over the next 3 to 4 years, if you bought junior miners in 2003, unless you were the worst stock picker on earth, you made 10 bagger after 10 bagger after 10 bagger. And portfolios that were $100,000 in 2003 became $1 million in 2006. If the person had any idea of what they were doing whatsoever, it wasn't that difficult. So it becomes more difficult the deeper you get into the bull cycle, and it's fraught with more pitfalls the higher prices go. But in 2003, it was early stage still, but it was 2 years into a bull run. And look at where we are now. I believe the bull market, the cyclical bear market ended in August 2018. That's my assumption, my opinion. It's not a fact. It's my opinion based upon all the information I have in my understanding of the sector and the chart. So we're just 2 years and 2 months into this new cyclical bull trend in a secular long-term bull market in gold, right? It's very similar to maybe where we were in October, November 2003. Now, it doesn't mean that things go up in a straight line, although this was a very nice steep ascent in gold for 10 years. There were pullbacks along the way. And at times, for example, in 2008, there were some very steep drops that served to shake a lot of people loose, right? And then also, I'll mention the relative strength index. So I'm using the monthly chart of gold here. I'm using the 14 period, relative strength index. And notice how it got into overbought territory where the RSI goes into dark green above 70. It got into overbought territory at some point in early 2006. But early 2006, gold was $600 an ounce. It didn't peak until 1923 in August 2011. The RSI went deeply into overbought territory, twice more over the next 5 years. This bull market has just gotten into overbought, dark green, for the first time in this cycle. I would have to say that we have at least 2 more years left at minimum, and potentially as many as 5 years in this cycle, in this bull market cycle. And we'll see the RSI gyrate between probably 60 on the downside and 90 on the upside. There will be a time when things get so extremely overbought and price so stretched to the upside that the monthly relative strength might even get to 90. We saw it in silver in May 2011, and I wouldn't be surprised if it happened again. So we move to the daily chart. We've been in a consolidation since early August, and I believe that gold is just about to transition into its next uptrend. All the fundamental factors are aligning. I've gone into them in some detail. I'm not going to waste any more time going into even more detail, but I'm sure probably some of you even better than me, the fundamental factors that are aligning here for gold that will move it back above 2,000 and above 2,100 over the coming months. Silver is a very similar setup, and just from a technical standpoint, you could say there's a double bottom here. It's not perfect, but it's good enough. For gold, I'd like to see it get above 1950 on a weekly closing basis to give confirmation the double bottom is in. For silver, I'd like to see it get above $26 an ounce on a weekly closing basis to give confirmation the bottom is in. And then there's this reflation trade that is very strong. Probably has a lot to do with China coming back online. Their economy is humming right now. So China's where COVID was ground zero for COVID at the end of 2019, and they've emerged from it already. And their economy is booming, at least by the numbers that they put out. But hey, it is what it is. But the FCX chart, Freeport-McMoRan, big copper miner, very profitable copper miner, especially at $3.10 per pound copper. That's a very nice uptrend. And these trends tend to keep going. They tend to keep going. Regardless of who's president, I think the reflation trade is very much alive and well for the reasons we mentioned earlier. The Fed, the ECB, modern monetary theory, governments completely addicted to spending and buying votes and pandering to the populace. We're probably going to get a big infrastructure building program in the US next year, probably something in the Eurozone, as well. And the US dollar. So the final chart that I'm going to show, and then we can talk individual stocks. The US dollar, this is a very classic bear flag on the daily chart in the US dollar index. You have this very strong downtrend from March to September or late August, and it's been digesting between 92 on the downside and 95 on the upside. When 92 breaks, I would have to guess that it opens up for a move down to 88. And such a move lower in the US dollar will be will offer strong tailwinds to precious metals and resources and mining shares. So that's my presentation for the day. It really, I want to use the next 2 months of 2020 to buy my favorite junior mining stocks at the best prices I possibly can. That's usually the lowest prices I possibly can. And tax loss season will probably start in about a week. It'll probably go on for another 3 or 4 weeks. It usually ends with about 2 weeks left in the year, and then we get a lift in the final 2 weeks, sort of a Santa Claus rally, the final couple weeks of the year in the stock market and in the juniors. So you want to be making your shopping list, and I'm going to have a blog post out in the next couple of weeks about my shopping list, the stocks that I like as tax loss buys, because everybody's been selling them and they're cheap and attractive. But you want to make yours. You want to own companies that probably don't need to raise money, at least in the next few months. You want to buy companies that have strong management teams, relatively tight share structures, and stocks that will be targets. The biggest targets for tax loss selling over the next 4 to 6 weeks are probably going to be ones that don't have a lot of news flow over the next couple months, or the prospect of much news flow, because everybody will just be like, I'll dump it now, get my tax loss, and then I'll buy it back in January, because they're not going to do anything or say anything anyway, right? So that's the number one thing as far as tax loss candidates, companies that aren't doing much and don't have a lot of news flow lined up over the next couple months. And then you want to look at stocks that are down year to date. So where were they January 1st? Where are they now? If they're down year to date in this year we've had in the gold and silver sector, then they're going to be probably some targets of tax loss selling. Or maybe they did a financing at a much, much higher share price earlier in the year, and those shares are now free trading. Those will be tax loss candidates as well for tax loss selling. So those are just some general rules for what to look out for in terms of tax loss opportunities and also candidates. So some individual companies. So I don't know much about Great Bear Royalties. I actually like Great Bear, the stock itself, the junior mining company that has a fantastic project in Red Lake. I actually like that one, and I'm a buyer of that one on any weakness into year end. I still got to think this company's going to get bought out in the next I don't know. It's hard to put a time frame on it. I'm just making up a time frame from what I do, but it's going to get bought out in the next year. Okay. There's just not many, there's not any, projects of this quality in the world. There's just not. So, Newmont, the biggest gold miner in the world, put out their earnings last week, and they generated US $1.3 billion of free cash flow in a 3-month period. Earnings are getting better among the seniors, and they need to acquire more ounces in the ground. And they're going to put that money to work. As long as gold stays up 1,900 or plus, these companies are cash cows. I mean, they're just churning out huge amounts of free cash flow. Their shareholders want growth. Dividend, it's nice, but it's so fucking boring. Give me growth. Give me earnings growth, even more free cash flow, sexy assets. That's the stuff that's going to get the stock price going. So I say that Great Bear is still at the top of my list. Any thoughts on Banyan Gold or Maple Gold? Banyan Gold, I was talking to Tara Christie just a couple hours ago. And I'll say this, it's such an impressive company. I bought more stock today. I got filled at 25 cents. I've got bids under the market, 24, 22. I will be a buyer of Banyan if people want to sell it to me at lower prices. I'm happy to pick up more shares at these levels. Yeah, they have the seasonality issue in the Yukon, But you know what? They're still drilling. Can you believe it? It's sub-zero freezing temperatures up there, and they're still drilling. That's how good this project is in terms of its location. They've drilled 8,300 meters so far this year, I think, or maybe a little more. They'll probably get to 10,000, before they shut it down for the year. At some point, they will have to shut it down in the next few weeks, and they'll be back again in March. But meanwhile, you got news flow because the assay labs, these labs are so backed up. She's telling me that she doesn't have anything to put out to the market because they've just been so slow. And this is a major problem in the sector. I mean, the turnaround times are 2 to 3 months. It's just absurd, but it's what we're dealing with. If you're a long-term investor, you welcome lower prices for high-quality companies. It's a better opportunity. It's just you have to have some patience. Banyan Gold, top-notch name to buy on weakness. If somebody wants to sell it at 25 cents or 24 cents or whatever, I'm sure there'll be plenty of buyers, and we'll get through this next couple months. And meanwhile, you have a top-tier asset with a top-notch management team. And Banyan's got over $4 million in cash, no funding needs for quite a while. They have very low cost to drill. Yeah, I'm not going to tell you my biggest tax loss selling targets now because I want to buy them over the next couple of weeks. So I'll tell you in a couple of weeks after I buy a few. But I just gave you the rundown of what I look for. So you can figure it out on your own. Tonopah, we got to hear something from BlackRock and Summa soon. I mean, I own both of them. Not too happy with the recent price action, but I'm sticking it out. I really love these two stories, and I think hopefully we're going to get some news soon from both companies. Yeah, so I mean I own both, so I am biased, and they're also sponsors. Vizsla, so Vizsla has 5 drill rigs going now. I mean, and they expanded their program. Again, this is a company that is well cashed up. The stock has been beaten down, just like a lot of other silver juniors. Buy low, sell high. I mean, that's all I can kind of say here. I'm sure we're going to get news flow. The story is the same for many of these companies. They've got tons of core samples in the lab. They're drilling every day. There's going to be more and more news flow coming out that will last through February or March. It's just unfortunate right now that we've had this challenging 2 to 3 months in the sector. We've had some paper from financings done earlier in the year come free trading. That's pressured shares lower during a lull in the news cycle. It's just sort of a perfect storm, but it's created opportunity now. And so that's what I'm trying to point out here over the next 3, 4, 5 weeks. I think there's going to be tremendous opportunities. There are some opportunities right now today. And as I said, I was buying some stock this afternoon. Is it reasonable to expect a pullback of more than 50% during a bull market? Well, first of all, what are you talking about? Are you talking about a junior mining stock, or are you talking about the S&P 500, right? If you're talking about the S&P 500, 50% drop is big. It's very, very big. It's once in 2 decades or 3 decades event, right? For a junior mining stock, it's like a once a year event. It happens. It's just something that you have to understand. A stock that can go up tenfold in 2 or 3 months can also get cut in half in 2 or 3 weeks. It's the nature of the beast. It's these small companies are extremely volatile, and they're extremely prone to exaggerated movements based upon market sentiment extremes. And so just like we started off this conversation talking about market cycles and Howard Marks, so these cycles play out on much shorter time frames in the junior mining sector. Of course, there's macro cycles that drive the micro cycles in the junior mining sector, but we have these micro cycles happening all the time, over 3 to 6 month periods. So yeah, I mean, 50% drops happen. In fact, there's a quote from Rick Rule where he said that pretty much every 10 bagger he's had two 50% drops on its way to becoming a 10 bagger. It's the nature of the beast. European Precious Metals Summit. Any favorite one-on-ones? Yes. I like Maritime. What's Maritime symbol? I got so many stock symbols in my head. I want to make sure I get it right. MAE. MAE. I'm not going to get into it because we're running short of time, but I really liked my conversation with the CEO. This is one that I would buy on any weakness. There's a little bit of a warrant overhang, I think, for the next few days or a week. So maybe wait till next week. See if you can get it at 14 cents or 13 cents. MAE on the venture. I really like that one. I don't know. Otso Gold. CNC. Yes. Canada Nickel. I own Canada Nickel. Am I a buyer of it at $2? Well, if I didn't own it, yes, I would be a buyer at $2, but I already own it. So I'm not buying more at this point in time. But I took some notes on a conversation I had with Mark Selby earlier today. And he basically said that the network will be out by the end of the month. That's very important for the PEA. So it will inform us as to the recoveries that they expect to get at Crawford, and that will affect the economics of the PEA. So that's important news that will be coming out in the next few weeks. We'll get more assets. So this is the same story with every single company. He's waiting for multiple assays for multiple targets. We should get those sprinkled throughout the rest of the next few months, probably a couple prior to year end. And then we have the PEA by the end of the year. So the maiden PEA, which is a very important milestone for the company. I think that should be a driver for the stock. Probably some buying in anticipation of that once we get closer to that PEA. So everything, I mean, this is a very high quality company in every aspect. There's very few junior miners that check all the boxes like this one does. So yes, I'm a big fan. And if I didn't own it, I would be buying it at $2. Do we have any other questions? Let's see, co.ca. Okay. Just some comments on what MMT is, modern monetary theory. I think that's it. We're almost at the hour mark. Any other questions that anybody has, you can toss out there. But yeah, just the best thing I can say is that keep focused on the bigger picture cycles. Don't get too caught up in news, the day-to-day news, all this fire hose of news that we get spewed on us from the mainstream media, the financial media, from other investors, blah, blah, blah. So don't get too caught up on that day-to-day. Use the insanity of the day-to-day, week-to-week market gyrations for your benefit, not to your detriment. And so I believe that the next 2 months, and probably more, to be more specific, the next 4 to 6 weeks are going to be a tremendous opportunity to get one's portfolio and investment set up and poised for what is to come. And what is to come is going to be very beneficial to precious metals and resources and mining shares, and specifically the junior miners that have the best management teams, the best projects, and management teams that are aligned with shareholders like you and me. And we talked about some of those companies already here today, like Banyan Gold, Summa Silver, et cetera, et cetera. Canada, nickel, and I could go on. There's quite a few. I'm sure you know the ones that I follow, but resources are increasingly scarce, increasingly expensive, and difficult to extract from the earth. So find the companies that are finding the best, most economic, resources out there. Get your timing somewhat right, and I think you can do pretty well in this market. So thank you for your time here today and this afternoon. I hope you guys have a great, rest of your day and your evening. And thank you for tuning in.